It's really great to be here with you guys today. So I'm the closer. So we're going to try to keep this interesting and lively and get you all to cocktails rather soon. So yeah, I saw that with Jeff. He had a little. It's tricky, this clicker. So digital labor and economic perspective. Now, we heard a little bit of the economic aspect of technology and digital labor from Ray Kurzweil, and we heard a little bit more from Jeff. In fact, Jeff's closing question, his answer was interesting about the Pew study. I'm actually quite surprised it was 50-50. I would have expected it to be much more 90% negative and 10% positive. And why would I say that? Well, let's look. So automation anxiety is nothing new, actually. It's been going on for quite some time. So here we have machines would exclude the labor of thousands of the human race who are usefully employed. Anybody want to guess when maybe this was said? 1811. All right, you guys are a little late. A little late. This was Thomas Mortimer in 1772. I would suggest that the first real piece of digital labor was the Jacquard loom. So the Jacquard loom was the loom that all the Luddites started protesting. It took punch cards, and you inserted them into the loom so that it could create very intricate patterns. And the idea was that now there was not going to be any more work. And this was in the early 1800s, 1804, 1805. But this technology and this automation anxiety existed before the Jacquard loom was even invented, right? So this is something economists have been very, very fearful of, and predictions of our demise as human workers has been, greatly over-exaggerated, right? So it continues. This is another pretty famous economist. For the moment, the very rapidity of these changes. So how many people now hear, oh, everything is going so much faster now? Right now, it's so much faster than it ever was before. Here we have a quote from some time before now. We're going to let you guess who it is and when. Very rapidity of these changes is hurting us and bringing difficult problems to solve. We're being afflicted with a new disease of which some readers may not yet have heard the name, but which they will hear a great deal in the years to come, namely technological unemployment. Right? Anybody know who said this? Pretty famous economist. You guys have all heard of him, I'm sure. Keynes, very good. All right, 1930. Oh my gosh, technological unemployment. The number of jobs lost to more efficient machines is only part of the problem. What worries many job experts is that automation may prevent the economy from creating enough new jobs. Now, we had a problem, a perceived problem in our economy in the 1960s. Does anybody know what that perceived problem was in the early 60s? Johnson created a commission to study it. The problem was we had too much productivity, right? Too much of it. This was Time magazine, too much productivity. Now, we're worried that we don't have enough productivity. Robert Gordon, a very famous economist, very well-known economist, has just written a very, very large 765-page book, basically stating that all of the great technological improvements are behind us. Once you have plumbing, electricity, and railroads, penicillin, it's all downhill from there. Nothing can compare. Right? We're never going to get productivity gains again. And this period of strong growth that we had through the 1900s, that's the anomaly. If we look back through all of history, growth has been very, very meager. And in fact, we're going to return to that. We're going to return to that period where growth is very, very meager. And then, of course, a pretty famous economist who studies technology and who's pretty positive on technology. This is a pretty negative quote. Digitalization is creating new types of economic disruption. In part, this reflects the fact that as computers get more powerful, companies have less need for some kinds of workers. Even as it races ahead, technological progress may leave some people, perhaps even a lot of people, behind. This is Eric Brynjolfsson from MIT, right? Very recent quote. So this automation anxiety is really nothing new. It's been going on for a long time. And I was very encouraged by that Pew report where it was 50-50. I thought that was okay, good. People are feeling more optimistic. So what's digital labor, really, from an economic point of view? What is it? Right? I think we need to define it if we're going to talk about it. So is it when machine perform routine tasks that were previously performed by humans? Is that all it is? I don't know about that. I think this new phase of digital labor that we're talking about is different than the Jacquard loom, right? Which was obviously, in some respects, digital. I think it is when machines perform cognitive tasks that were previously performed by humans. So what's cognition, right? And I wrote that, I got the definition, I copied it up here, but I think that, I think Jeff really covered it very, very well. It's more than just accumulating knowledge. It's more than just processing that knowledge. It's having subconscious thought. It's having interaction with other people. It's having that empathy. It's having our brains merge together. The synapses in our brains reflect the synapses in the brains we're talking to, the people we're talking to. That, I think, is part of cognition. And I would also submit to you that it's creativity. Creativity is a big part of cognition, right? And that idea that Jeff was talking about, people working together to solve problems, that type of creativity, when machines can do that, then maybe we will be obsolete, right? But until then, and I think that's some ways off, I think that we have a big future for human beings to do lots of interesting things in the realm of work, in so much as we want to be working. Okay, so there is an economic concept about labor and capital, right? There's two inputs, labor and capital, and you get some sort of output. And labor and capital, you put in labor, you put in capital, and out comes your output. And this is how we look at total factor productivity, a very important thing in understanding how an economy can grow. And when you have an improvement in total factor productivity, you're putting in the same amount of labor and the same amount of capital, but you're getting out more, right? Now, Solow, who's a famous economist in the 1960s, came up with a theorem that capital and labor are perfect substitutes. So the quantity that you produce is a function of the amount of capital and the amount of labor that you put in, and you can equally substitute capital and labor. So what does this mean? This means that technological investment is in part a function of the business cycle. If wages are very high, it's going to make sense to invest in capital rather than labor. It's going to make sense to invest in automation. If wages are very low, it might make less sense, right? There's going to be less of an impetus. Where we are in the business cycle is important because where interest rates are is important. Is it going to be inexpensive to go to the capital markets to access capital in order to invest that capital in machinery? Or is it going to be expensive, right? Tesla announced today they're doing a new share issue, $1.4 billion to fund their new plant to build their Model 3s, right? It's good time to go out and raise capital in the capital markets. And wages are relatively inexpensive, so we haven't seen as much capital investment in this recovery as we have seen in other recoveries. So this relationship between capital and labor capital substitution is important in thinking about how swiftly certain technologies will be upon us, because it really gives an indicator of the way markets are going to perform investment. Now, capital accumulation is also important. So cognition involves knowledge, and this whole idea of acquiring a body of knowledge and using that to leapfrog forward is very, very important. It's one of the reasons developed economies have been able to grow so much faster than emerging market economies. They have much more knowledge embedded in them, right? So this is the capital stock, the light blue line. The bars are the year-over-year increase. And we see that we really haven't had a decline in the capital stock since the Great Depression. Right? There was a little bit of a decline back in the 30s. It slowed, the accumulation of capital year over year slowed during the recent financial crisis, but it didn't fall. And now it's been growing at a slower rate year over year than it was previously, but like I said, it still hasn't fallen, right? There's an economist, well, he's actually not an economist, he's a physicist from MIT. His name's Cesar Hidalgo. He's written a really great book that you might be interested in called Why Information Grows. And he talks about the complexity of information being one of the key determinants of whether or not, what an economy's future growth rate is going to be. And certainly in our information age, this is more important than ever. So when we think about what is information, right? How do you look, what is information? It's embedded in so many different things. It's embedded in our phones. It's embedded in automobiles. So we have here an example of an automobile. Anybody see what this is, a Bugatti? Anybody know? There's some interesting things about the Bugatti that some of you may know. Steve Hill, our colleague who couldn't be here this week, would know a lot about this. He's a car aficionado. But the Bugatti is not only the fastest car in the world, it's also one of it is the most expensive car in the world. Does anyone know how much it sells for? 2 million, 2.5, 2 million, close. And another really interesting fact about the Bugatti and the way it's made. Does anybody know about this? Handmade. Every single part in this car, the most expensive car in the world, is handmade, right? There is a precision that is valued in that hand making. Now, there's a lot of technology in this car. Probably some of the greatest technology in the world is in this car, arguably as much as in the Tesla or the Google car, right? But the value of this car is not, in fact, in the sum of the different commodities that make up this car, right? The value of this car is the information that it contains, the information that causes it to be able to be the fastest car in the world. And should your Bugatti crash, it is not going to be worth as much. Now, this is not a Bugatti. You're going to notice it's not, because there really are no pictures of any crashed Bugatti anywhere that I could find. But if your Bugatti crashed, right, it would be worth much, much less, because a lot of that information would have been destroyed, would be non-operable. And this is something to think about when we think about digital labor and think about this accumulation of information. Watson has accumulated lots and lots of information. That's part of what makes it valuable. And then it has to understand relationships between pieces of information, right? Now, what we found as we've studied, we've many decades now of technological advancement. We have many centuries, actually, 2 centuries, 3 centuries of technological advancement. And what we've observed, or what seems to be the case, is that future advancement is dependent upon what the most recent advancement was. So software development is iterative. Technological advancement is iterative. And so when we look at the amount of investment as a % of total investment in software and equipment, right, we can see that it's risen consistently over the last 80 years. But there's something in the most recent bits of data that are important, and that is it seems to have a bit of a business cycle, right? So we had little ups and downs as we go along here, but most recently we led up to the dot-com boom, we had a bust. We led up to the global financial crisis, we had a bust. So one of the other things that's coming out in the literature about technology and automation is that the more dependent we are as societies on technology, the more digital labor we have, in fact, the more we will be prone to technological booms and busts. So this idea that we have tamed the business cycle seems to be being turned on its head when we look at the impact of technology within the economy. Now, I said there's labor capital substitution, so we have to look at labor. The average price, we are much below the long-term average price year-over-year increase in wages. This is all wages within the economy. And if you look back in the period of the 50s and 60s and even the 70s and early 80s, wage costs on a year-over-year basis were much higher. So if you were doing labor capital substitution, there was much more incentive to invest in capital and to invest in automation because it was less expensive, right? Now, as it turns out, it really depends what kind of worker you have, right? So workers that are highly educated, right? STEM workers, they are what we call an inelastic supply, right? It's not infinite. And in fact, when demand goes up, the price goes up. But non-skilled workers, routine manual occupations, the kind of occupations where they get replaced all the time, in fact, those are what we call elastic supply. There's lots and lots of those workers, and because there's lots and lots of those workers, the price doesn't really go up very much. So that brings me to my third point about technological advancement and the economy, which is that we have seen, not only in the US but globally, a sort of hollowing out of the middle class because the middle skill jobs now have largely been automated. The middle skill, middle income jobs are getting more and more automated. And it's the high-end jobs that require a high level of cognition where the technology is a complement to the job, that we're seeing more wealth accumulation, that we're seeing higher wages and higher wage pressure. So if we look at the share of people with bachelor's degree awarded in science and engineering, it's actually down a little bit from what it was in the early 60s. It's turning up slightly. One has to wonder if there isn't going to be greater demand for these professions, if one isn't going to see this move up more towards 40% of the college students. Now, what this graph doesn't depict, in fact, is that the number of people that have received college degrees has gone up significantly. And in the last decade, the number of people who have received advanced degrees, masters and PhDs, has gone up really dramatically. We've seen a big surge. I mean, I can't remember if it was Ray, I think it was Ray who mentioned that earlier this morning as being a pretty significant factor in human capital over the next several decades, because as we said earlier, everything is cumulative. Oh, here we go. Okay, so one of the other things to keep in mind is that the labor that creates, the digital labor has to be created by somebody, right? That's created by labor. And in fact, if we look at the components of research and development, the cost, if you look here, the dark blue line represents the labor cost in research and development. And in most cases, it's the labor cost in research and development that is the highest cost. Right? That makes sense. You need really smart people collaborating, apparently with empathy, to create interesting research and development. Now, what about digital labor and economics analysis? Okay, so we've gone over that long-run decline in the labor share of income, so that's basically saying the middle class is being hollowed out. Tech booms and busts, and growing dependency on current output of past software investment. There's some other interesting research around technology. So one of my favorite economists who studies this is David Autor. He's at MIT. And aside from doing really great work, I really admire people who are willing to recognize that they were incorrect in their previous analysis as they start to do more work and they say, actually, I don't think I got that right. We have more data now. So here he corrects his previous prediction. And he said, while some tasks in many current middle-skill jobs are susceptible to automation, many middle-skill jobs will continue to demand a mixture of tasks from across the skill spectrum. So I think that I'm actually pretty optimistic about the labor force and what people are going to do. Right? I think that this automation anxiety has been pervasive over the last several centuries, and it has never proven to be correct. That we are infinitely creative, and that in addition to receiving money in exchange for working, people receive a level of satisfaction from many of their jobs. And I think sort of one of the most interesting things is what Jeff said earlier about even cleaning people. Having empathy and optimism are the two most important skills. Now, this is a relatively low-skill job, right? And yet those factors of empathy and optimism are what make people really good at that job. And it suggests that a whole variety of jobs give a sense of personal satisfaction, that you're contributing to your community, contributing to the world, contributing to life around you. And I think that there is sort of an intrinsic desire to work. Nevertheless, we have a really interesting situation. Now, when I've explained this to people who are not technology people, this is really a pretty astounding fact. But if you look at computing power per hour, right, in the 1950s, right, what was one unit of computing power became 10 to the 12th by 2015. That is a remarkable, remarkable increase. And that type of growth in computing power was not seen until this last 60, 70-year period, right? So while Keynes perceived that the speed was increasing, the speed of computing power literally has increased at phenomenally exponential rates over the past 6 or 7 decades. And that certainly impacts what computers are able to do and the type of assistance that can come from automation and digital labor. However, we look at an example of a digital labor. I think of tellers, ATMs is a form of digital labor, right? So when ATMs came on the scene, the idea was, well, actually, we aren't going to need any more bank tellers. And in fact, banks were very happy about this because there was a high number of turnover in the number of tellers, right? They were hard to train. They made a lot of mistakes in adding and subtracting, right? So their ledgers at the end of the day didn't always balance out. And so they were really excited about ATMs coming on the scene and not needing any more tellers, but it turns out the ATMs did one function. There was a very routine clerical function that humans actually weren't always that good at, and that the tellers were better at doing the types of things that Jeff talked about, right? They were better at relating to the customers, at doing relationship banking. at getting them to purchase other services from the bank, at creating a stickiness with the customers. And so, in fact, the number of tellers has actually gone up, even as the number of ATMs has skyrocketed. Now, if we look at robots, industrial robots around the world, this is another thing that you read an article in the Wall Street Journal that says, robots are growing at a faster rate. So I took the number from the, is it the international, what is it, the, this is the IFR statistical department. Well, there's an international robotics organization, which I also took some data from. In any case, if we look at the blue line is the year-over-year increase, and you can see it's not actually faster than before the financial crisis, even though there was a drop in the number of robots that were put out during the financial crisis, and then of course that's increased. So we're certainly moving off of a higher base, and we're seeing greater amounts of robotics, right? But what's interesting is that when we look at what's happening to the labor force around the world, there are many countries where the working age population is falling, right? So Japan, the working age population has been falling since 1993. China, it started falling this year. Most European countries saw their working age population start to fall in 2010. In the United States, our working age population is increasing at a slower rate, right? And so there's also worry about actual labor shortages in many, many different professions. So if we look at the countries with the highest robot density, part of this has to do with the type of products that they produce, North Korea, Japan, Germany, right? But the United States is up there, it's above the average. Below the average is China. Now this is not surprising because until recently labor in China was very cheap, right? So you had no reason to substitute capital for labor. Recently, the Chinese government has made a big push to say we need to get into robotics, we need to do more robotics. That's partly because wages have gone up, right? And so China now is sort of in an interesting position where it's trying to play catch up. And it's consuming a lot of, it's buying a lot of robotics. There was a bid recently from a Chinese company to buy a German robotics company. I think it's called Roka? Anyone? All right, anyway, so China is making a splash, and you'll see lots of headlines about China's changing the face of robotics, but actually China is behind. China is playing catch up in the robotics department. If we look at a case where jobs did go away, right? So we have the agricultural industry where the share of people employed in agriculture went down dramatically, but of course productivity went up, and so the output for agriculture went up dramatically as a percent of GDP. We've had the same thing happen in manufacturing. The share of people employed in manufacturing has gone down, whereas the output has gone up. And that share of people employed in manufacturing has gone down rather dramatically over the last 30, 40 years. So we had 1 million jobs lost between 1990 and 2000, and then we saw this acceleration where between 2000 and 2007 we lost 4 million jobs in the manufacturing industry. Now, what happened during this very same time is that we had a housing boom. And so a lot of those people who lost manufacturing jobs were in fact able to get jobs in the construction industry. So that cushioned the blow a little bit. But once we had the financial crisis and we lost a whole bunch of construction jobs, then we started to see the impact in labor force participation rates. And we saw it specifically in labor force participation rates of men between the ages of 35 and 54, right? And to this day, the participation rate of men without a college degree age 35 to 54 is below levels that it was seen up until the 1980s. And this is certainly an interesting shift within our economy, and there is a lot of reason to believe that automation has something to do with that, right? And it's interesting. I couldn't have planned it better. I didn't really know. I've skimmed through Jeff's book. I have it, Humans Are Underrated, but I didn't know exactly what he was going to say. And it's just kind of interesting that he talked about how women are much more empathetic and have skills that seem to be more in demand in our current economy. And then we look at the data of who is actually not participating in the labor force because they have become unemployed, and it actually is men between the ages of 35 and 54. So there seems to be some corroborating evidence here that these are the types of jobs and the types of people and the part of the economy that are getting disintermediated. I would submit to you, too, this has something to do, this contributes to our current political environment, right? So That's where we see a lot of disaffected voters, and it doesn't matter which side of the party, by the way. We have disaffected voters on both sides, but there's certainly people who feel like they're being left behind as this digital revolution occurs. And we see this actually globally, right? So the routine occupations, which is the light blue line, is falling. Non-routine manual occupations is falling much more dramatically, the green line. And the dark blue line, which is non-routine cognitive occupations, is in increased demand. Right? Doesn't matter if it's the emerging markets, the developed markets, north, south, east, west. This is what we're seeing as a universal feature of the labor markets worldwide. And yet, in the United States, we've seen the employment to population ratio go up, right? I think Ray talked about this morning. He said that we saw women enter the labor force. And recently, we've seen this number fall because in the early 2000s, the baby boomers started retiring. And so the labor force participation rate has been going down a little bit, and then of course we have those men between 35 and 55 that are about 3 or 4 million of them that are not participating in the labor market, right? And we're seeing people stay in education longer, so that's impacting the labor force participation rate, right? As people go back and get those master's degrees and doctorate degrees, they're not in the labor force, they're in school. But if we look, generally speaking, during this whole period of automation over the last several decades, we've seen an increase in labor force participation. So it would be a dramatic shift if the current technological revolution that we're seeing, if the singularity that Ray talks about arrives and puts people out of work, it would be a dramatic shift from what we've seen over the last 2 centuries in terms of technology and the labor force. And then just one final thing about multi-factor productivity. All through this time period, productivity has gone up. And of course, it was going up at a faster rate in from the 60s to the 80s. It grew at a somewhat slower rate in the 90s to the 2000s. And then most recently, it's flattened out a little bit, which has people concerned. Although there's a strong argument that we're not measuring it correctly. There is also another strong argument that we could easily be on the verge of a surge in total factor productivity as digital labor comes in and really starts to impact the services industry, right? Because where we've seen the most advances in technological improvement have been in manufacturing, agriculture. We haven't seen big improvements in services. And one of the services where we have not seen improvements, in fact, where productivity has been declining, is, well, there's actually 2 sectors. It's healthcare and it's education, right? Healthcare is one of the key sectors where I think we're going to see massive increases in productivity from the next wave of technological advancement, right? So whether it's Watson helping out doctors at Memorial Sloan Kettering, diagnose cancer and reduce the number of treatments necessary for the average patient, whether it is a robot performing basic surgeries, we are definitely on the verge of seeing much more technological advancement and productivity gains within the healthcare sector. So getting quickly to the business cycle, we're in a situation that I would call rates low for a long time. So I had to start tweeting in 2011. Twitter came, it was a little, I don't know, been out a year or 2. And so it said, Constance, you should start tweeting. And I thought, okay, well, I have to figure out what this is about. And it appeared that people had hashtags. So I thought, well, I need to create some hashtags. And so I created this hashtag, rates low for a long time. And I thought, well, this is a good hashtag. I should have this for a year, maybe a year and a half. You know, and then rates are going to start to go up again because the economy is recovering and the Fed will eventually start raising rates. Here we are. This is my best hashtag ever. It's 2016 and I haven't had to change it. So we can see now not only are rates low in the US, but that there are places in the world where rates are below 0. So this is a rather new concept, so I'll spend just a minute on it. What happened? Negative rates started in Denmark. Denmark's central bank's only goal is to keep its currency pegged to the euro. And in order to do that, they went to negative rates so they could maintain the peg. Then the European Central Bank discovered that really there wasn't a lot of bank lending going on. So in Europe, financing occurs through bank lending. Corporates in the US, 25% of their financing is bank lending, 75% is the capital markets and the private lending market. In Europe, it's the other way around. 75% of the financing for corporations is through banks, 25% is through the capital market and the private market. So the fact that the banks weren't lending was a significant problem for the European economies. And so the ECB said, you know what? In 2014, they said, you know what? If you leave excess reserves with us, we're going to charge you for them. We're going to charge you a penalty. We're going to charge you 10 basis points on an annualized rate. And rather than leave your excess reserves with us, this should incentivize you to lend them out to households and corporations. And you know what? It worked. Banks started lending out to households and corporations. Europe saw a little bit of a pickup in their economies and a little bit of a recovery. But then it stopped working as well. We saw it sort of trail off. So the ECB in the beginning of this year kind of pulled out all the bazookas and said, you know, not only are we going to charge you 10 basis points, we're actually going to charge you 40 basis points for excess reserves kept at the central bank. And in addition, if you choose to lend, we will pay you to lend money. We will pay you 40 basis points a year to lend out excess reserves. So they're really trying to get bank lending going. Now, what's happened in the course of this is the ECB has also engaged in more quantitative easing. That is, they've bought up more government debt. They've started to actually buy corporate debt. So McDonald's did an issue last week in Europe, or 2 weeks ago maybe in Europe. $3.5 billion of 10-year paper. Anybody know what they paid in the market, what they had to pay? What interest rate they had to pay in the market? 75 basis points. 10-year paper, McDonald's, $3.5 billion issue, 5 times oversubscribed, 75 basis points. Why? Because there's a good chance the ECB will go in and bid up in the aftermarket some of those bonds. Right? It was issued with European banks. It was issued in Europe. And it meets all the criteria for the ECB to continue expanding its balance sheet. So as a result of this quantitative easing that we have seen in Japan and Europe, we now have negative interest rates on government bonds, right? And that's what this graph depicts in Europe and Japan. Now, if you have deflation, right, your real yield may still be positive. But this is a new game. This is a brand new situation. In fact, Bernanke talked, you might remember, about what we call the zero lower bound, right? The idea being you can't take rates below 0. It turns out actually that you can. And this is a brand new economic experiment. There are people who think that it's, obviously some central bankers who think it's going to go well. I'm a little skeptical that it's going to create the exact incentives that the central banks think that it will. I think it has some possible negative consequences. And so when we look out at the business cycle in the near term, this is very positive for the labor capital substitution, right? Because capital is very cheap, right? Extremely cheap, getting cheaper, right? So it bodes well for technological advancement. But it also means that sometimes we could have, talking about these booms and busts, we could have capital allocated to things that it ordinarily wouldn't be allocated to if rates were not so low. Right? So there's definitely room for some problems to arise as a result of this policy, but it's important to know that this is happening because it impacts, I think, the technology landscape. Now, if we look around the world, actually, growth is not too bad. So green indicates growth, red indicates recession. And if you notice, most of the red countries, with the exception of Japan, they have something in common. Anyone notice what that might be? They are commodity exporters, right? So commodity prices are depressed, not just oil, although oil has been going back up. And Canada was red until recently. Russia was red. China has been back and forth from red. And so some of these countries are really on the border line. But if you look, basically, the world economy is doing okay. And interestingly enough, despite this very low interest rate environment, I find this very interesting. The IMF World Bank forecasts for growth out until 2021 are above the long-term average. Now, you would think that it would actually be below the long-term average, which is why we would get these interest rates. But in fact, what's happening is that the developing markets have become such a much bigger part of the global economy that they're pulling up the total world growth rate, and the emerging markets do not have the negative rates or the very low interest rates. It's actually the developed markets that have the very low interest rates. I submit to you that this technological revolution, and certainly digital labor, the thing that has closed that gap between the developed world and the emerging world, the developed world and the emerging world, that is going to go away. We're going to reverse some of that. So that gap that when Ray showed that graph of the dots moving up the graph, as everybody became better off, I think the divide between the developed economies and the emerging economies has a strong possibility of widening as we continue to have more and more digital labor. and I only have a minute and a half left, so I can't go into all the details, but if anyone wants to talk to me more about it later on this evening, I can talk to you more about why that's the case. So if we look at the expansion rates, and this is 46% of the world economy, the largest developing economies and regions, we're looking at relatively strong growth. This is based on the PMI index. It's more high frequency than GDP, and above 50 indicates growth. So Japan's struggling a little bit, but if you look at the EU and the US, we're doing okay. We're having slow and steady growth. In the US, we have actually been deleveraging. So McDonald's, by issuing debt at 75 basis points, can retire some of its more expensive debt, right? And it cleans up its balance sheet, and essentially it's deleveraging. US households are deleveraging. And so US growth with no leverage is about 2%. We have consumption running at about 3% on an annualized basis. We have housing adding 30 to 50 basis points a quarter. And then we have some other things subtracting, like trade, and capital investment goes up and down each quarter. We have government subtracting because there's been fiscal austerity, right? So when you add it all together, we get about 2.5% GDP growth rate each quarter. And of course, it's going to be more volatile than my forecast here. But we have a nice, steady, slow growth rate. And this is what growth looks like when it's not too imbalanced and we aren't taking on a lot of debt. And I think this is actually a pretty positive environment for technology investment. As I said, labor prices are not going up dramatically, but in certain fields, they actually are growing up pretty significantly. And so this will begin to cause labor capital substitution, or capital for labor substitution, I should say, and low interest rate environment will also continue to promote that. So, in conclusion, we have to remember that the accumulation of knowledge, both by humans and computers, is accretive to future growth. Right? Digital labor from ATM and to Watson has so far enabled complementary assistance to human knowledge workers. And I don't really see that going away particularly. If we get tighter credit conditions, I do think the Fed will raise in June, but that may be the only rate hike that they do this year. It could impact the rate of investment, and digital labor will be impacted. I think it's going to be impacted by the credit cycle, but because we have such low rates around the world, the Fed cannot raise the short end of the curve that much because we will end up with a flat and possibly inverted yield curve. Right? So if you're a bond investor and you have a choice, you can pay the Japanese government 10 basis points to buy their 10-year debt, or you can receive 180 basis points to buy US Treasuries. What do you think? If you have a choice, what are you going to do? Right? You're probably going to buy a few more US Treasuries and a few fewer JGBs. Right? And so this keeps our long end of the curve low, which means the Fed is limited as to how much they can raise the short end of the curve, and it's going to greatly slow the rate hiking cycle of the Fed. And this, I think, will ultimately be good for investment, and certainly technology falls into that category. And then finally, we're looking at sort of a slow and steady 2%, maybe a little higher in some quarters, depending upon what's going on with consumption or the rate of the dollar. We're looking at a steady, slow 2% growth rate, obviously impacted by certain quarterly events, but for the average for the year, we're looking at about 2% growth for the next several years. So I think with that, we'll wrap it up and take some questions.